Take a moment and pour yourself a glass of wine. What you hold in your hand is a beverage meant for enjoyment, for a quiet evening, a celebration, or a dinner party. Yet for a select few, that same liquid in a different bottle is not a drink, but a high-performing, tangible asset, a centuries-old commodity now traded in a digital marketplace. We are talking about the secret world of fine wine investment, where a single corked bottle can be worth more than your car, your annual salary, or even your house. This is not about the latest Cabernet you picked up at the store. This is about a highly specialized asset class where scarcity, reputation, and immaculate history converge to create astonishing value. Today, we're decoding the sommelier's secret. What transforms simple fermented grape juice into a multi-million-dollar investment, and how this liquid asset class is defying conventional finance. The engine of value: rarity, ageability, and provenance. What separates a $1,000 bottle from a $20 bottle? The answer is simple in theory, complex in execution: longevity, scarcity, and provenance. First, a wine must have the structure to age. Investment-grade wines, the crème de la crème of the global market, are built to improve for decades. This means high levels of acidity, balanced tannins, and concentrated fruit designed to soften and harmonize over time. As the wine ages, it enhances its complexity, flavor, and quality, becoming more desirable. Crucially, as the quality improves, the supply diminishes. Point 3. Every time a bottle is consumed, the remaining stock becomes instantly rarer. This creates the classic supply and demand dynamic that drives prices higher. The more coveted and scarcer the bottle, the higher the value it commands on the secondary market. 4. The vast majority of the world's wine is not made for this. Less than 1% of global production qualifies as true investment-grade wine. 5. Finally, and perhaps most importantly, there is provenance. Provenance is the documented history of the bottle: who owned it, where it was stored, and how it was transferred. 6. In a market plagued by sophisticated fraud, like the notorious case of Rudy Kurniawan, provenance is the assurance of authenticity. A bottle with an impeccable paper trail, verified by a reputable auction house or storage facility, can be worth dramatically more than an identical bottle with an undocumented or questionable past. 7. This focus on verifiable history ensures that you are buying the legend, not the lie. The Sommelier's secrets: decoding the investment mechanics. Investing in wine works differently than stocks or real estate. It operates largely through two core mechanisms: the en-primeur system and the secondary market, tracked by sophisticated indices. The en-primeur, or wine futures market, is dominated by Bordeaux. Investors purchase wine while it is still in the barrel, often 18 to 24 months before it is bottled and physically released. They receive a certificate of ownership, paying a discounted price in anticipation of the wine's quality and its future scarcity. This system allows merchants to finance the vintage and allows investors to secure bottles from highly sought-after producers before they hit the general market, maximizing their potential profit margin. Once released, bottles enter the secondary market, where they are traded between collectors, brokers, and investment platforms. 10. This market is benchmarked by the LIVX, London International Vintners Exchange, indices such as the LIVX 100 or the LIVX 1000.11. These indices track the price performance of the most traded wines, providing transparency and data that was once reserved only for the elite few. 12. This data confirms that fine wine is not merely a hobby. It is a measurable asset class that, over the long term, has historically offered returns competitive with traditional equities, all while acting as a hedge against inflation and broader economic downturns. The trading volume and price movements on the secondary market are what truly determine the investment value of any rare wine. The blue chips, regions and producers that command value. The vast majority of investment-grade wine originates from a handful of prestigious Old World regions, though the market is steadily diversifying. 13. These are the blue-chip names that anchor any serious wine portfolio. Bordeaux remains the cornerstone. 14. The 5 first growths: Premier Cru Classé, Chateau Lafite Rothschild, Chateau Latour, Chateau Mouton Rothschild, Chateau Margaux, and Chateau Haut-Brion are the equivalent of the Dow Jones Industrial Average. Their track record for quality and longevity in exceptional vintages, like 1982, 2000, 2005, and 2009, is unmatched, making them essential, reliable investments. Burgundy represents the ultimate expression of scarcity. 15. Due to the fractured ownership of tiny vineyard plots, climate, producers like Domaine de la Romanée-Conti, DRC, Domaine Leroy, and Armand Rousseau produce minuscule quantities of Grand Cru wines. When these bottles hit the market, particularly from celebrated vintages, their rarity ensures prices soar, making Burgundy the sector most prone to astronomical returns. 16. The high demand and microscopic supply mean Burgundy prices are often the most volatile, but also the most potentially rewarding. Beyond France, key players include the Super Tuscans from Italy, such as Sassicaia and Macedo, which blend traditional Italian winemaking with French varietals to create internationally acclaimed, age-worthy wines. 17. Prestige Cuvée Champagne, led by brands like Dom Pérignon and Louis Roederer's Cristal, has also solidified its position, offering stable returns and a high degree of liquidity. Finally, a small but powerful contingent of cult Napa Cabernets, Screaming Eagle, Harlan Estate, and Scarecrow, have established a robust secondary market driven by intense U.S. collector demand and exceptionally low production. These global names are the foundation upon which a fine wine portfolio is built. The crucial role of condition, protecting your liquid gold. For a wine to maintain its value, it must be stored in near-perfect conditions. 18. This is where the concept of storing in bond becomes paramount. Storing wine in bond means placing it in a professionally managed, temperature and humidity-controlled warehouse, typically in the UK, that has been approved by customs and excise. 19. This professional storage protects the wine from the four great enemies: heat, light, vibration, and temperature fluctuation. 0.20 optimal conditions are a steady temperature of around 55 degrees Fahrenheit, 13 degrees Celsius, and 70 to 80% humidity. 21. Improper storage, even for a short time, can damage the wine, leading to poor fill levels or cork failure, drastically reducing its value. 22. Beyond preservation, in bond, storage provides critical financial benefits. 0.23 wine stored this way remains exempt from local value-added tax, VAT, and duty. 0.24. When the investor sells the wine, it can be transferred still in bond to another investor or merchant without ever incurring these taxes, making the asset much more attractive and liquid on the international market. 25. For an investor, the paper trail generated by professional bonded storage is the ultimate proof of provenance. 26. No serious buyer will touch a wine that has been stored in a private home cellar or worse, an unverified location, regardless of the label. Investing in wine means investing in its vault, the risks and rewards of the fine print. As with any asset class, wine investment carries unique risks alongside its substantial rewards. 27. On the risk side, wine is fundamentally a collectible, not a company, and it does not pay dividends. 28. It also carries high associated costs, professional storage fees, insurance and brokerage commissions for buying and selling can erode returns if not accounted for. 29. Furthermore, while fine wine is less volatile than many equities, it is an illiquid asset. It may take weeks or months to find the right buyer, especially during market downturns. 30. The biggest non-financial risk remains fraud and poor provenance, underscoring the necessity of purchasing only through reputable brokers or auction houses. 31. The rewards, however, are compelling. Wine offers a crucial diversification benefit, often performing independently of the broader stock market, thereby hedging risk. 32. It is a tangible asset that can be used to pass wealth through generations, and unlike stocks, a case of first growth Bordeaux from an exceptional vintage is a finite, diminishing resource, a true store of wealth. 33. For many, the reward is also emotional. Owning a piece of history, an exquisite work of art that can be opened and enjoyed at its peak maturity. Conclusion: the new portfolio of passion. The investment world has changed. The sommelier's secret, that the world's finest wines are a stable, high-performing asset, is now out. The modern rare wine market is a fascinating blend of old-world tradition and new-world technology, leveraging digital indices and bonded warehouses to trade a perishable luxury good. It is a sector where passion meets profit and where the decisions of a few hundred producers in France, Italy, and California determine the value of a global commodity. To invest in rare wine is to invest in patience, history, and the beautiful certainty of finite supply. If this deep dive into the paradoxical world of wine investment captured your imagination, be sure to give this video a like. Share this video with a fellow collector or investor, and most importantly, subscribe to our channel for more fascinating looks into the intersection of finance and luxury.